So, turn our attention to our special segment, Quarter Se Quarter Tak, where you get your expectations from each sector. Today, Sonal turns the spotlight on the oil and gas space. Sonal, over to you.
Thank you so much for that. Well, this time around, the oil and gas space is expected to report a mixed quarter. Remember, Singapore gross refining margins, they rose sharply by about 97% on a quarter-on-quarter basis in quarter three to around $7.5 per barrel. At the same time, Brent crude prices declined by about $5.4 per barrel on a quarter-on-quarter basis, averaged at around $63.6 per barrel. Let's start with the big boy Reliance Industries. The oil to chemicals business that is expected to report strong growth led by higher refining margins. Overall, EBITDA for the company is expected to rise by around 5% on a quarter-on-quarter basis. The retail segment is likely to see growth of around 4% on a YY basis, while oil to chemicals business will see strong growth of 15%. Reliance Jio is expected to post revenue growth of around 4% on a YY basis. Let's switch to the oil marketing companies now. Standalone EBITDA for HPCL, BPCL and IOCL, all three companies, is expected to increase in the range of around 9 to 18% on a sequential basis, expecting strong refining margins this time, and the receipt of LPG compensation is something which will aid earnings for the companies. Upstream companies, they're expected to see a weaker quarter. Oil and gas volumes for both ONGC and Oil India are likely to largely remain flat both on a quarter-on-quarter and on a YOY basis. However, realizations are expected to decline by around 7 to 8% considering the crude oil price fall. EBITDA for both the companies as a result could also fall by 7 to 8% on a YOY basis. Let's talk about city gas distribution companies. They are expected to report strong earnings, supported by healthy volumes and margins. So Mahanagar Gas is expected to see volume growth of around 12 to 14%, the highest in the sector. IGL around 5%, while Gujarat Gas could see a volume decline of around 8%. Let's now talk about gas utilities. They're expected to deliver moderate performance. Petronet LNG is likely to see flat EBITDA growth, while growth for GAIL and GSPL is expected to be lower. Let's end this with valuations based on FY27 earnings. Reliance trades at around 27.2 times, BPCL at 10.1. We have IOC, HPCL between 7.8 to 10.7. Among city gas players, Indraprastha Gas trades at around 15.9 times. It has come off from its highs. Mahanagar Gas at 11.3 times, and Gujarat Gas continues to be the most expensive in the CGD space. But you know, a lot has changed since quarter three. In fact, in last 10 days, we've seen so much happening in terms of global macros, supply, etc. So the most important part in these results will be the management commentary.
Indeed. Thank you very much for that. We also have with us Dayanand, Mittal, Oil and Gas, Telecom and Oil and Gas Research Analyst at JM Financial now joining in. Thank you very much for joining in. You know, as Sonal said, right, the backward-looking data is there, but as we look ahead, we've seen a surge in crude oil prices now with $65 per barrel for Brent. So the street will watch for the commentary and what lies ahead. So lay out the picture for us in terms of expectation and what we could hear from the management.
Yeah, good morning. So yes, obviously, you know, crude price has been highly volatile last few years, and we saw sense of that last few weeks also with all those talks about this 500% tariff, possible US attacks on Iran. Hopefully not, but yeah, in case because Iran is a big supplier of crude, almost 3.5% of global production. So any disruption there would be very sensitive for Indian companies' earnings. So obviously, management would have very limited visibility to comment much on that. So it will be more dependent on what US president decides, and various other geopolitical factors would be key. So I doubt management will say, but yeah, uncertainty in earnings for OMCs and ONGC Oil India will continue. As we know, lower oil price is good for OMC's earnings, OMC's marketing business earnings, while a higher oil price is good for ONGC Oil India's earnings. So yeah, probably the volatility in the sector will continue, I guess.
So going in for Q3, which are the pockets that you like where we could see an earnings surprise? There is a bit of a risk, a mismatch between what the companies might deliver and consensus expectations?
So given in oil and gas sector, most of the variables are known ahead of the earnings. So not much surprises per se. So in 3Q, OMCs will report very strong earnings. So that strong earning momentum for OMCs will continue. Key event for them would be, in terms of future earning outlook, would be whether a government let them make this high marketing margin with the earning right now, or there could be an excise duty hike ahead of budget. In terms of other companies, it would be largely a soft quarter. ONGC Oil India, given $4 to $5 QOQ decline in crude, it will be a soft quarter. Gas companies, given LNG prices have been high, though it has moderated off late. But from a 3Q earning perspective, volume will be soft, even for gas companies. Some recovery, but not major. In gas companies, the key event would be when spot LNG price moderate, which we believe is more like a second half CY26 story with a lot of LNG supply capacity coming in. I think that should aid their earnings over the next 6 to 12 months.
Okay, hi Dayanand, good to see you. Nigel on this side. As you said, maybe these OMCs, the street is already preempting very good numbers for quarter three.
Yeah.
At current juncture, what is your preference between the oil producers as well as some of these oil marketing companies? Because crude oil prices, some on the street believe that maybe it's forming a bit of a basing out process, and from here we'll actually see crude oil prices move up. In that sort of a scenario, would you be leaning now towards producers or you stick with the OMCs?
So our preference has always been towards ONGC Oil India versus OMCs, primarily because OMCs are on aggressive capex spree on refining and petrochemical, where we think it's a value destructive process from a minority shareholders perspective. This project tends to be a single digit ROC in refining because of the terminal value concerns, in petchem because of the intense competition from China. So OMCs and also OMCs valuations have been above historical averages. Of late, the correction has meant that now they are in a fair value zone, but we don't see much upside here. And given this excise duty hike risk, I think better to stay away from that name till the clarity emerges. ONGC Oil India is what we like. Particularly, Oil India is a top pick in the oil space. We think it's a 15% earning compounding story over the next 2 to 3 years because of the strong output growth in the oil and gas business, and also NRL, which is a refining subsidiary that is expanding the capacity from 3 million ton to 9 million tons. So that would also, because that refinery has got a huge tax incentive benefit. So that could be a strong contributor to Oil India's earnings over the next 2 to 3 years.
On oil marketing companies, you were saying the question is going ahead, will they be allowed to enjoy the high refining margins, or will we see an excise duty hike in the budget which caps it? What's your own expectation?
So our retail petrol diesel price breaks even at about $70, $71 Brent. So $70, $71 Brent, OMCs make a normalized marketing margin. So when crude was $60 few days back, they were making almost like 6 to 7 rupee per liter higher marketing margin. But now crude is at jumped to 65. So the extra margin that they're making is in the range of 3 odd rupees per liter. So government is in a tricky position. The call would be a function of where do we see crude price stabilizing. So a few weeks back, we thought excise duty hike is almost a done deal, given they're making 6 to 7 rupee higher, plus government revenue was under a bit of pressure. But now with crude having moved up, I think government might be in two minds. So difficult to say. So it's a tricky call. That's the nature of the industry behind.
Dayanand, I'm not sure whether you track MRPL and CPCL. Those stocks, they burst up, and then in fact now they've cooled off yet again. We know the refining margins actually have been holding pretty strong. And globally as well, there's a bit of a shortfall in refining capacity. So we understand, post-Russia-Ukraine war. Any view with regard to refining margins, as well as if you have a view on either of these names, do you think they still have more headroom to move up?
So we don't officially cover, so I'll not comment on those two companies. But the reasons those companies moved up because diesel cracks went up from average of $15 to almost like $25 to $30 since last 2-3 months. This was because of talks about sanctions, US and EU sanctions on Russian oil, which led to some temporary disruption in diesel supply. But with the ongoing progress in Russia-Ukraine deal, those concerns have abated. Plus, winter, which is a seasonally strong period for heating oil demand, winter this time in Western Hemisphere has been moderate. It has been largely a warm winter. So the heating oil demand has also been a bit soft. And hence, diesel cracks have moderated back to $16, $17. And that's the reason the stocks have corrected back. In terms of refining margin, yes. So long-term refining margin, there are a lot of concerns because of EV-related impact on oil demand. Maybe 5 years, 10 years down the line, difficult to say. But long-term terminal value concerns in refining business stays. But in the near term, impact of EV on oil demand has been more on the lower side than what was anticipated. While the refining capacity addition from private players have been very limited because of those EV-related concerns. So capacity addition is falling short of even the modest oil demand growth, and that's what is supporting GRM. So we think in the near term, GRM may remain healthy, around $6-7 for Singapore GRMs, for OMCs around $7 to $8. So it should be healthy for next 2-3 years. Long term is where we are a bit worried.
Dayanand, Reliance Industries, that's down 8% since the start of the year. What is your own read of the fall? And when you speak to investors, how are they taking the decline in the stock price? What are the key concerns that they flagged off?
I think the biggest reason for the weakness seems to be doubts over sustainability of kind of 12-15% EBITDA growth in the retail business. Given last few quarters, it has been one quarter has been strong, another quarter has been weak. So no clear trends there. Management broad guidance seems to be retail EBITDA growth could be in the range of 15%. In AGM, the management has been guiding for around 20%. Maybe because of this, their foray into quick commerce, where revenue growth is all right, but as we all know, quick commerce as of now doesn't make money, doesn't make EBITDA, and hence the EBITDA growth is where there's a lot of uncertainty and concerns in the near term. I think, but in the medium to long term, I think they should be able to deliver 15% EBITDA growth, given they're taking a lot of steps to recorrect the challenges which they're facing. I think that's the key reason which is dragging the stock. Telecom businesses, they're doing absolutely fine, so no concerns there. Oil and gas is like petchem is weak, continues to be weak. Refining is strong as we discussed, so largely neutral from a Reliance perspective. O2C is largely neutralish from Reliance perspective.
No, absolutely. And Dayanand, we'll leave it there. Good conversation. Thank you for your perspective. Appreciate your time here on CNBC TV 18.